Hey people, I welcome you all to Caroline's Online Academy. This is a series of videos through which we are understanding the various concepts that are required to understand accounting for share capital. So we're taking small numerical problems and understanding new concepts with each of those problems. We're in type 3 now. We'll be discussing oversubscription of shares. What do you mean by oversubscription? Oversubscription refers to a situation wherein a company issues a certain number of shares, but the number of applications asking for shares that reach the company is more than the number of shares issued by the company. For instance, the company issues 1 lakh shares. It is the applications that are asking for shares are 1 lakh 30 or 1 lakh 10 or 1 lakh 1. Then the number of applications that are coming in for subscribing to the company shares are more than the number of shares issued by the company. It is a situation of oversubscription. We are going to understand how to account for that now. I'll also show you a practical, recent example of how many times Zomato shares were oversubscribed. If you see, Zomato shares have been oversubscribed by 38 times when it made the initial public offer. Okay. So in such a situations, how does the company go about accounting for it and what all can it do? We're not going to study everything now because the company has a lot of choices in front of it, but we'll take the basic way of doing it. So I have a question for you here. It is basic issue oversubscription. Dhanvant Limited issued 1 lakh shares of rupees 100 each, payable as follows. Application rupees 25, allotment rupees 20, first call 20 and second call is remaining. The company issued 1,30,000 applications and the company received 1,30,000 applications. So it issued 1 lakh shares, but it received 1,30,000 applications. So it cannot allot more than the number of shares it issued, right? So it only allotted 1 lakh applications to the applicants of 1 lakh shares while rejecting the excess application. So in a situation like this, when the company has received more number of applications than number of shares it is issuing, and if it is rejecting all the applications, and how do we go about accounting for it? So we're going to learn in this problem. The first transaction in any issue of shares problem is the receipt of application money, which you very well know. And the journal entry for that is bank account debit to equity share application account, if it is equity share. Equity share application. If it's preference share, then it will be preference share application account. Equity share application account. And what is the amount? As I already told you, it's a number of applications received multiplied by the application money per share, because that is the amount of money that the company would have received. What is the number of applications received by the company in this case? In Dhanvant Limited's case, the company has received 1,30,000 applications in this issue. Am I right? So that will be 1,30,000 multiplied by application money of 25 rupees each. Application money received. All right. Now moving on to the second transaction. In this case, what the company does is the excess applications have been rejected. That is, you say I only have 1 lakh shares and the remaining 30,000 applicants. You tell them that sorry, we don't have shares to allot for you, and we are rejecting. Now, when we reject the applications made by a shareholder, the company is supposed to refund the money received from the applicant. Understood. So the second journal entry here would be slightly different from the earlier journal entry. So before we make the allotment, we've got to refund the application money on the rejected application. So when we refund the application money, equity share application account will be debited because that liability is getting reduced now. As we are giving the money back, the liability is getting reduced and we are giving the money back, right? So the money in our bank account is going to decrease. When I say R, it means the company's bank account is going to decrease. So we are refunding. What is the amount? How to calculate the amount for this? We are refunding the application money on the excess applications. How many excess applications did we have? We had 30,000 excess applications. We received 1,30,000 applications and we are only allotting 1 lakh shares. So 30,000 is excess. 1,30,000 minus 1 lakh. 30,000 excess applications into 25 rupees per application, that is application money per application, shall be refunded by the company as the company has rejected the shares. Application money refunded on rejected applications. All right. So once we are done with the rejection, what we're going to do next is we're going to allot shares to the remaining applicants. So when we allot shares to the remaining applicant, it comes with two transactions. The first transaction is transferring all the application money received from the other applicants to the share capital account because they are not applicants anymore and they become shareholders of the company. And therefore, the journal entry for that would be equity share application account debit to equity share capital account. And how much would you transfer? It is you've allotted 1 lakh shares and the application money received on those 1 lakh shares will be transferred to the equity share capital account. So that will be 1 lakh into 25 rupees. The application money received on those 1 lakh shares, or it is the equity share application money that you receive minus the amount that you refunded on the rejected applications. So that will also amount to the same number, which is 25 lakhs. So shares allotted. The next transaction would be to make the allotment money due. Now that we made the allotment of shares to the applicants, we will tell them it's time for you to pay the allotment money. Kindly go ahead and pay the allotment money. So when we make the allotment money due, we debit the asset account called equity share allotment account. It's a personal account in traditional approach, and equity share capital account will be credited. The logic behind using these accounts and why it's debited or credited has already been explained by me in the video in which I taught the basic journal entries for accounting for share capital. Allotment money due. How much would that be, my dear children? You got to go and check. You've allotted how many shares? 1 lakh shares. And allotment money that you're supposed to receive per share is 20 rupees. So the total allotment money receivable here would be 1 lakh into 20, that is 20 lakh rupees. Alright. Now once we have allotted the shares, what happens next? After we have allotted the shares, after we have made the allotment money due, the shareholders would pay the money to the company. Am I right? So the company is going to receive the allotment money. So as I've already explained, when you receive money, bank account will be debited because it's increasing and it's an asset. An equity share allotment account will be credited because that asset is getting reduced now. So that's 20 lakhs. Received allotment money. All right, children. Now the next journal entry would be what the company would wait for some time, and then as it is announced, after a point of time, it will actually make the first call due. What does it mean? What do you mean by making the first call due? It means that the company will call all the shareholders and tell them that it's time for you to pay the next installment, which is the first call. So we have to make the first call due. So an asset account called equity share first call account will be debited. In traditional approach, it's a personal account to equity share capital account to equity share capital. And what is the amount that we're supposed to make due? In order to understand the amount, we need to look at the question again. Along with first call, we're supposed to receive 20 rupees, and therefore the amount that we're supposed to debit is number of shares, that is 1 lakh allotted, that is 1 lakh into 20 rupees per share, which is 20 lakh rupees. Equity share first call made due. Alright, now when we make the equity share first call due, what happens? The shareholders would pay the equity share first call and the company would receive it. So we would receive money and therefore our bank account will be debited. We in the sense company. Bank account debit to equity share first call account. Equity share first call money received. And how much would we receive? As there are no defaulters, you will receive the entire money as everyone has paid the amount due on their calls. Alright, my dear children, after this, what would we do? After this, we would make the second call due. And how much is the second call? That is something, that is the number of shares allotted into the amount receivable per share in second call. So what is the amount receivable per share in second call? That is not given, it's given as remaining. But last time I taught you how to calculate that. The issue price of the share is 100 here. The shares are being issued at the par value. So the issue price of the share is 100. And we have received 25 with application, 20 with allotment, and 20 with first call. So in all, we have already received 65 rupees. A second call is a final call. We're supposed to be receiving the 35 rupees along with the second call. Understood, my dear children? So 35 rupees per share into number of shares allotted would give us the amount to be made due here. So 35 into 1 lakh is 35 lakhs. We made 35 lakhs due on making the second, when we made the second call due. And that will be how much. The journal entry will be equity share second call account debit to equity share capital. And when we receive the second call money, equity share bank account will be debited and equity share second call account will be credited. So that will be bank account debit to equity share second call. So it's as simple as that, my dear children. What actually happens when we have oversubscription is we actually there are a lot of choices with the company, but in this case, what the company has done is it has rejected the excess application. So when we reject the excess applications, all we need to do is we need to refund the application money received on the excess applications, and the journal entry for that would be equity share application account debit to bank account. And with that, and that's the only thing that is different here. So with that, we have come to the end of this video explaining accounting for oversubscription when the excess applications are rejected. We'll see you in the next video, my dear children. Till then, you people take care and have fun. Bye.